Portfolio Builder members, SPY is up 18.6% year to date, and we are up 92%. That's an outperformance of 394%. Plan is to let all the positions ride. Currently in the high risk portfolio, we have 2.5% long UVXY. And again, our product is built on units of investment. So if you log into your membership area, type in how much you have to invest. Currently, one unit is coming in at $5,879. And so this is the breakdown. For every $5,879, we own 15 shares of UVXY, 248 shares of TMF. That's betting on interest rates falling on the long end of the US Treasury curve. Leverage times 3, representing 22% of the portfolio. And that's what we call the defensive side of our strategy. On the offensive side, we've been making a fortune on Coinbase with ticker coin. You have 16 shares there. We're protecting against a inflation coming back scenario, which could happen for a number of reasons, which we'll cover. But we have 2 shares of NRGU. These are the big US oil and gas companies, 10 of them, leverage times 3. We own GBTC ahead of the big ETF rolling out, probably on January 10th, representing 15% of the portfolio. And then we're still long those magnificent 7 tech stocks that have been dominating all the profits in the stock market this year, FNGU. Again, that's your Facebook, your NVIDIA, your Google, your Tesla, leveraged times 3, representing 10.48%. Now, again, we're not following asset allocation percentages. We're all holding the same ratio of stocks. This way, we all get the exact same return over any period of time. In general, what we see coming is a strong economy fueled by massive deficit from the government, and then falling inflation for the next year and a half, most likely primarily due to shelter in place. Here's a look at our returns. Last year, we pulled a negative 12% return after being up as much as 60%. We got hit pretty hard at the end of the year with a really strong December to close it out. This year, we're up 91.68% with a great 29% return in November. We've only made a few trades this year. It's been a very boring year. Now that's our growth portfolio. The safe growth portfolio has been struggling because it looks for value investments, and the market's been rewarding super risk takers, and that doesn't always play out long term. However, in the safe growth portfolio, we have a unit cost of $2,051. Per unit, we have 2 shares of UVXY, the deflation hedge. That's the VIX. If the stock market were to crash tomorrow, that would go up significantly. We're going to probably buy more of that around January after we get this expected Santa Claus rally. We have 114 shares of treasuries, representing almost 30% of the portfolio. TMF, leverage times 3 once again. We've been playing Asia for about 2 years. I think this is going to finally play out. I'm going to add money to this probably after we take profits on GBTC, and probably a little bit off of our treasuries, because I think Asia is about to really kick ass. If we're going to have a falling dollar and falling interest rates, emerging markets tends to greatly outperform the S&P 500 by several multiples. So we're using EDC to get EEM times 3. That's 12 shares. We've got the Bitcoin Trust, 22 shares with GBTC, the biggest position in the portfolio and what's made the bulk of its profit this year. And then we're long oil, gas and oil companies, leverage times 3 with NRGU at 20% of the portfolio. So this one's been playing it very safe, still having a good month, up 15% alone this month. I see very few changes to this portfolio, and I think it's going to have an outstanding outperformance 2024, 2025, while playing safe investments that are undervalued. Our high risk one has been chasing momentum and is much riskier. If you're interested in joining the advisory, call Dean now at 505-322-7515 to get the whole scoop and even a free trial. We'll give you a free trial. We'd love for you to make $10,000 following the program before you pay a penny. Just call Dean to get that now. No credit card required. Okay, first of all, let's look at liquidity, the most important aspect. So we got the stock market rolling up rapidly this year, yet we've had central banks outside of China reducing liquidity in their balance sheets. So you can see that the Fed, ECB, and Bank of Japan have all been selling treasuries, and it's really just China that's been injecting liquidity. The market's clearly predicting that this is going to change soon and result in a massive liquidity boost. And again, the key to this is that inflation is falling so that the central banks can stop raising rates, pause rates, stop doing quantitative tightening, and eventually start cutting interest rates. And this is going to be a huge economic boom. We believe this will be designed to be very good election year with what Janet Yellen's doing with the Treasury market. We'll cover that more. This is looking at the ISM 15 months ahead of the global liquidity index, and you can see it's pointing to about a year and a quarter of massive liquidity hitting markets. And again, the election cycles tend to be very bullish years for stocks. Now, the main reason we're quite confident that inflation is going to fall is primarily that about a third of the CPI is in the shelter in place. And we've seen that housing prices are falling pretty rapidly on new houses, and that the rent data has been falling for over a year. But the way they measure it is a year delayed. So we're about to see a third of the CPI really influenced by falling housing and rent costs. And here's just a zoomed in look at the new home price. And the whole real estate market's been frozen by these extraordinarily high interest rates. Now, once the front end of the bond market starts to price in rate cuts, you're going to see this massive $5.5 trillion in U.S. money markets. It's at around 8 trillion globally. Is going to look for a new home, and that's going to be stocks, long duration bonds, cryptocurrencies, real estate, commodities, you name it, anything except your money market fund, because that 5.5% lovely rate you're getting risk free is going to evaporate. Our favorite investment in the short term is Bitcoin, because there's a big ETF getting launched, most likely January 10th, and it's going to be pushed by all the biggest money managers in the world. So this is quite an exciting event. Plus, we have the Bitcoin halving, which makes the cost to mine Bitcoin double. And so again, all these big booms in Bitcoin have lined up with elections, Bitcoin halving cycles, and interest rates falling. So we got this perfect setup. We're predicting a 180,000 Bitcoin price around November of 2025 as a just a basic guess. And the owner of Masari says, can you imagine BlackRock, Fidelity, Wisdom Tree, Franklin Templeton, Invesco, Grayscale, Bitwise, ARK, Valkyrie tripping over each other to sell Bitcoin harder than their competitors on January 10th? Now, notably, the Bitcoin has not been going up in relativity to the hash rate. That's the difficulty to mine Bitcoin. And what we believe is these big banks have been buying Bitcoin from miners to keep it a little bit secretive and keep the price from running up too quickly. And so we can see this has gone from 300 hash per second to 500, just this massive increase. Now, again, if you want to learn more about our product, call Dean now at 505-322-7515, and you can get a free trial to our advisory right now. We want you to make $10,000 before you invest a penny in our program. No credit card required. All right, so Recession Watch, we're watching the 2 and 10 year. Now, remember, this has been artificially manipulated to invert as the Fed rose interest rates rapidly up to 5.5%. So the long end didn't see that level of interest rates necessary while they forced the front end up. And that's what made it go inverted in the last year. Now we're seeing it start to uninvert. And all of the steepening of the yield curve has led to a recession, but it's about 12 to 24 months out from where you invert and start to rise. So we're watching this carefully. So far, we're not even back to uninverted. We got a long ways. I'm expecting most likely a recession to occur in 2025. Here's the 2 year starting to dip. And again, the faster that 2 year and 3 month bond market products start to fall, you're going to see all this money rush out of reverse repo and out of money markets into essentially equities. So we're getting ready for that big move. Here's a look at TMF. It's been through a 2 year bear market. Looks like we're at the end of this as long as inflation continues to fall. Again, we're looking at oil, gas, and housing markets to really predict what's coming down the pipeline for CPI. But we're starting to see a nice bounce in TMF here, up about 31% in the last month. And again, this has been a big position for us for quite some time to hedge against essentially the risk of interest rates going up too quickly and breaking the economy. Here's a look at DXY, the dollar index. You can see when We had that huge spike to about 120, I think it was 126. That's when Russia invaded Ukraine, and we had natural gas and oil skyrocket to absurd prices and created this global inflationary shock. Since then, it's been settling down and falling. We believe this is going to fall for the next 2 years to be very, very beneficial to emerging markets, cryptocurrencies, and the stock market in general. We can see it's been trading flat all year and most likely heading significantly lower. Now, we're not saying the dollar is going to be replaced by the BRICS or anything of that nature, just simply that foreign currencies are going to get a bid as the dollar has a probably about a 1 to 2 year pullback here. Here's a breakdown of the interest rates per product. And we can see at the highest interest rate in the 3 month, we got 5.4. And then our lowest print is on the 10 year at 4.29, excuse me, 4.24 on the 5 year. And a little bit higher on the very long end of the curve with the 20 year at 4.6. Here's the yield curve displayed in another way. You can see that oddball price on the 20 year. And again, what we're going to be worried about is when the front end starts to fall rapidly and the long end goes up. And that'll be our sign to really get out of stocks and probably load up on bonds. That's assuming that we're looking at deflation hitting the economy for a recession and not another inflationary shock. Here's your 30-year trend. You can see it's been going down for decades. I don't buy into the call that we're going to have decades of inflation and hit 10, 15, 20% interest rates. It would break every government globally. They're going to do everything in their power to manipulate these lower. We're likely headed to rates we've seen in Japan and Europe, so closer to zero, when we probably want to end our position in TMF. Here's FNGO. This has been one of our big gainers this year for the high growth portfolio, up 387% year to date. Coinbase, our biggest position currently, 285%. It IPO'd at 400, fell to 25, and now a bunch of retail people have bid it up to 128. I'll probably hold this towards 150 to 200, start peeling off on it. And again, I want to be holding this at January 10th for a few months when all the hype and selling happens for the Bitcoin ETF. And again, Coinbase now has a monopoly globally on crypto thanks to the Department of Justice taking down Binance this last week. GBTC is more of a pure play, up 260%, keeping up with Coinbase almost. So again, just two ways to play that same space. I see that as the single greatest investment in the next 3 to 6 months, and really in the next year to 18 months. Emerging markets is being played with EDC, that's EEM times 3. And again, we think this is finally going to start to kick some butt. Gives you something like 4,000 companies out of Asia, not just China. So a lot of growth opportunities there that are extremely undervalued. In the last month, it's finally getting a bid. This is lining up very correlated to TMF, up 21% the past month. China has now bent the knee to the US. They are desperate to get NVIDIA chips from Taiwan. So they're basically essentially saying they're going to start buying our debt if we let them have chips, and they're not going to invade Taiwan. So looks like the war in Ukraine, Russia paid off, made Russia look like a fool, and really crashed the entire European economy, putting US in a very strong position of power headed into the next several years. Here's a look at oil. If oil were rising rapidly, or gas prices, we might be worried of a inflation shock, or copper for that matter, but all of it is falling quite rapidly, especially lithium. There's really no reason to think inflation is about to return anytime soon. Again, Brent oil down 31% in the past year, flat year to date, and only up 2.5% in the last 3 months. NRGU is our favorite play for that. That's our inflation hedge. Long term, once all the banks do start to loosen or give forward guidance that interest rates are going to come down and quantitative tightening is going to end, look for speculators to boost oil back to above 100, probably towards 120. And that's where we're going to get the next big profit taking opportunity on NRGU. And I do think that's coming in the next year or two. So we're holding on to this position after being down on it 27% in the last year. And again, here's a look at gold. We're not playing gold, but this is a good indicator of what could be coming for Bitcoin. It's about to break into new highs. So as inflation falls and interest rates remain high, the gold loves that opportunity, and it tends to skyrocket right after a Fed pause and inflation falls simultaneously. So we're not in gold at this moment, but keeping a close eye on it for a breakout. Silver, similar chart, but not yet at new highs. UVXY is our way to get a asymmetrical return on a stock crash. We just don't see that in the cards through the end of the year because again, we had record Black Friday sales, record Cyber Monday sales. GDP is coming in super hot. Labor market's still strong, and wages are growing while inflation's falling. So this is just a Goldilocks situation for stocks. We'll start to add to UVXY sometime next year. Now, the high interest rates have caused massive losses that are unrealized on banks. And the high interest rate on the front end has made regional banks lose massive amounts of capital. It caused a big panic in the regional banking sector. So we're looking at KRE to look for problems here, and it does look like that is pretty much gone, and the market's been rebounding from 38 as a low to 45 today. We're not playing that sector, but looking at it for problems in the economy. S&P 500 up 17.37%, NASDAQ up 45%, Russell 2000 doing a whole lot of nothing. Pretty much all the gains are in about 7 big tech giants who are dominating profits via AI and just really everything they do. So Russell 2000 still trading flat at 1.3. We'd love to see this catch a bid to believe that there's a more long-term bull market coming. United States consuming has slowed down but keeps rising, as you can see in this chart. And again, it's just been slowing down that growth rate. Loans continue to grow even at these high interest rates, so showing that the credit in the economy continues to support a strong economy. Consumer credit change, again, also continuing to grow. And we're seeing the balance of trade start to fall, which is showing that we still have a strong import economy, but the demand is starting to go down, which would mean inflation should fall. As far as China being a heartbeat of the global economy, we're watching the composite PMI stay above 50. We've just made a deal with China, so I expect that to really ramp up. Their imports stay steady. Their exports, while falling slightly, are still healthy. Again, the perfect scenario for Goldilocks situation for stocks, cryptocurrencies, and soon, most likely, commodities and bonds. So it's going to be a buy everything melt up if this scenario continues. Want to learn more about trying our product, getting access to the membership area, call Dean now at 505-322-7515. I'll go ahead and look for questions and then get us back. Jenny says, what's the update on TMF? We're about to have a 2-year bull market in bonds, is my expectation. So yeah, I think that one's going to really shine, possibly out. If we go into a recession, it'll outperform everything. If we have a Goldilocks situation, it'll perform well, but probably not as well as our cryptocurrencies and our NASDAQ position. And again, typically, if we get an inflation shock, your NRG will go up and TMF will fall. So those two are highly uncorrelated or inversely correlated. So very good. We'll be doing webinars more often now. Just wanted to get to a point where we're near a trade alert because we've just been letting these positions ride, and it's played out very, very well. But yeah, I don't see us doing any trades in the December month, but we'll keep updating the returns and doing the videos. We'll probably take a week off around Christmas and a week off around New Year's, but other than that, expect a weekly webinar. Okay, great guys. If you're in Rebel Dividends, look for a update next week with a live webinar and a dividend on Monday. That product's ready to probably outperform everything under the sun. If you want to learn more about that, call Dean. That's a leverage play with private equity in crypto. Otherwise, call Dean to learn about joining our advisory. So thanks everyone for joining us live. Hope you've enjoyed today's content, and we'll be back next week.